Trading live capital is almost impossible when you let greed seep into your trading. Have you ever traded a live account and made a significant amount of money from an account flip? So much money that you would be happy if you withdrew that money and had it in your bank account. But you didn't withdraw it and you kept trading. You kept trading until the account was at zero. Well, if you've had this experience, you're not alone. Because I asked my entire Telegram group to drop a heart on this post if they also had this same exact experience. And the majority of people that saw this post within the first hour voted yes. And the reason why they voted yes is because psychologically we are all programmed the same. We are programmed with the understanding that money equates to hard work. If we work hard, we will have money. And in order to have money, you must work hard. But when you begin trading live capital and you flip accounts just like this, sometimes you're going to catch a really good trade and your account's just going to compound after compound. And it's going to flip to an amount that you would be really happy with. But you did it so easily that you don't actually understand the value. So in this video, I'm going to break down exactly psychologically why this happens to us, what we struggle with, and specific psychological facts that you have to understand about yourself to conquer the psychological things that are holding you back in your trading. So without further ado, let's hop into this video. My name is Marky and I upload 2 videos per week on this channel. If you want to see more educational content, not just on psychology, but educational videos on my strategy and the models that I use in a day-to-day basis to catch high probability trades in the market. Because while I firmly believe that psychology is 80% of your trading, that 20% is still there, and that 20% is going to make a big difference. Knowing the right strategy and using the right system to succeed in the markets. But one of the biggest misconceptions in trading is that your strategy is the reason why you're failing. And that's why in this video, I'm going to be breaking down 7 scientific reasons why you're failing as a trader. And these all have to do with your psychology. The first one is loss aversion. This means that we feel our losses much more than we feel our wins. So this inclines us to make back our losses because it's painful to take losses. We want to take wins. In order to overcome our losses, we try to replace them with wins. So this is what brings a lot of traders over trading or revenge trading. The reason why you revenge trade isn't even to make back the money. It's to try to experience that good feeling, because when you walk away on a loss, it's obviously painful, it's obviously hurtful, and you don't like walking away in a loss. When you walk away with a win, you feel really good. So a big chase in trading isn't even trying to make back the money. It's trying to chase that dopamine hit and that good feeling of making money in the market. The second psychological reason is hedonic adaptation. Hedonic means in relation to something pleasant, so something that gives us pleasure, right? And what gives us pleasure more than a win in trading, right? Nothing really gives us that same high that taking a high probability trade does, taking a big win does, right? But when we take that win and we're like, okay, we just took a 2K win, when that win was nice, when that's your first trade of the day and you started off with a nice win, you're not going to be humble about it. You took that win, what's going to happen? You're going to adapt to the bar and you're going to raise it higher. This is hedonic adaptation, where you take a win and you raise the bar higher and you try to aim for more. So instead of being happy or humble about taking a win and understanding that the market can take it just as quickly as it gave it to you, instead of understanding that, what you end up doing is you raise the bar and you're like, instead of walking away with the 2,000 that I just earned off this trade, I'm going to aim for 5,000. I'm going to aim for 1 more thousand. And that 1 more thousand is going to cost you the 2,000 that you made in the first place, because that bar is never going to stop raising. If you don't understand that trading should be more about your strategic approach in and out and understanding the market, but instead you start raising the bar higher and higher based on that good feeling of winning and how much you want to earn, that's going to cause you to stumble and lose the profit that you made that day. The third psychological reason has to do with our dopamine, and nowadays we are more fried than ever. People sit on brain rot content all day, on scrolling through reels on Instagram, scrolling through TikTok shorts or TikToks, and these things genuinely fry your brain when it comes to trading, because you have a standard for this high that you want to experience with your dopamine level. And when it comes to trading, you're going to get a high from winning. You're going to get a dopamine hit from losing, and it makes you want to take riskier positions. Do you remember what I said in the beginning of this video? Have you ever made a certain amount that you would have been happy with if you withdrew, and yet you kept trading because you made it too easily, just like this? That easy win, that risky trade that you took that gave you an easy win, gave you a high. It gave you a dopamine hit, And therefore, higher risk will give you more dopamine. The more you risk on your trade, the more you're going to have a feeling from it. But as traders, we should be emotionless. We should try to detach ourselves from the outcome. We should try to detach our feelings from the market. Because if you were just chasing the way that you felt, then you'd place a really high risk position every single time. Because that high risk position is going to give you a dopamine hit. It's going to give you a new high seeing those numbers circulate, numbers that you haven't seen previously. Stop doubling down on your risk every time you take a winning position because it's only going to bring you further back. Most of you guys need a dopamine reset because you don't even realize how fried your dopamine receptors are and how susceptible you're going to be to making emotional mistakes because you're chasing a feeling. You're chasing the feeling instead of following your system, and that's a big mistake when it comes to trading. The fourth psychological reason is overconfidence bias. This means that either through wins or repeated actions that give you what you're looking for, like if you are following your system and you take a certain amount of wins back to back, then this is going to support the bias that you have in your mind that you're a good trader or that you're an unbeatable trader, that you're a profitable trader. Early on, when you're finally starting to see that success, this overconfidence bias will make you double down on your risk because you're going to have too much confidence either in your strategy, in your system, or in yourself. And that overconfidence in yourself is going to make you forget about the market, and the market is going to humble you. I promise that if you don't humble yourself, then the market is going to humble you, and it's going to be painful. You're going to have a lower self-esteem and a lot less money than you came into the market with if you don't humble yourself before the market humbles you. The fifth psychological mistake is the sunk cost fallacy, which means that you've invested so much into it that you just have to keep going with it even though you know you shouldn't. Now, this typically happens with like businesses. You're holding onto a business that's making you lose money because you've already spent so much time into it. You've already dedicated so much money, time, effort, blood, sweat, and tears, and you don't want to give up on this business because you did all these things. It's like you've already put so much into it that you're just going to keep going with it. And this is like holding on to a sinking ship. It's sinking, and you know that it's sinking. You can see it sinking, but you're staying on it instead of hopping on the raft and restarting your journey. This sunk cost fallacy in trading essentially relates to your live account. When you flip the account or you spend a lot of time holding a trade, you try to keep holding the trade or keep going with the live account because you've already spent so much time or you've taken so much winning trades on it. You should keep going. But this is a sinking ship because you know that towards the end of every single trading day, eventually the volatility dies down and there's not going to be any more good opportunities for you to take winning trades or even just catch volatility in the market. This is a sinking ship because the further that you trade every single day, the worse the probability gets of you actually taking a profitable trade. The sixth one is illusion of control, which means that after a few wins, you have the illusion that you can predict or control what the market does. And therefore, you end up losing sight of the fact that there's going to be low probability or unpredictability in the market. Times where it just doesn't make sense. It just does something random. And even me with experience coming into the market, I know that there's times in the market where it just won't make sense. No matter how much times I've seen the market do its thing countless times over and over again, right? Following a certain set of pattern or even following my system. I still know and accept the fact that there's times where I come into the market and it makes absolutely no sense what happens that day. It makes no sense because there's either some news event or something else that can just throw it off completely, and it's going to be moving like you've never seen before. And that unpredictability will crush you if you have that illusion of control. If you let the winds get to your head and that overconfidence bias, then you're going to hop in expecting the same thing to happen that's been happening for you over and over again. Never lose sight of the fact that it's unpredictable sometimes. Always hold on to that. 2 losing trades, hop out of the market that day. Because if you don't hold on to that and you keep trading a low probability or unpredictable day, it's going to cost you a lot. And the last one is one of the most important cycles that we all trap ourselves in. There's the greed and fear cycle. So first of all, greed. What does greed drive you to do? Greed happens when there's money in front of you. This means that you're winning. So you're not just going to have mistakes when you're losing. You're not just going to keep repeating mistakes when you're losing. You're going to have the most mistakes when you're winning, because even past satisfaction, greed is going to push you to earn more. Greed is going to push you to do more, to keep taking trades because you're winning. One of the biggest things that traders tell themselves after they win is, now I have 2,000 extra profit for the day that I'm fine with losing. You're really not fine losing that, because I've been there myself. You say that you're fine losing that $2,000 profit that you have on the day, or that you're going to risk $2,000 profit because you made $2,000 profit to make 3 or 4. You're going to lose the 2,000. You're going to try to make back the 2,000 by the end of the day, and you're going to end up in drawdown, because that's what happens. That's the natural cycle of what happens. Fear, on the other hand, comes when you're losing. So greed comes when you're winning. Fear comes when you're losing. And fear comes with you trying to make back, getting out of drawdown. You take a loss, you're going to try to get out of drawdown because you're afraid of blowing the account. You can't end up on a losing day, or that your drawdown's going to trail up on your account. So you're going to try to get back up where you were at the start of the day, or get even higher than when you were at the start of the day. And this happens a lot with accounts that have trailing drawdown at the end of the day. So watch out for your rules and make sure you're not falling into this greed versus fear cycle. And the last scientific fact that I'm going to leave you with is that losers or bad trades are held onto 2 times longer than winning trades are. This means that when you're seeing profit in front of you, most people tend to close the position early. When you're seeing drawdown, you do not want to close that position, and you're holding on to that until you see green. And that's something that you should never forget, because it's going to cost you a lot of money. Remember, one of traders' biggest misconception is that it's their strategy or system that's causing them to lose in the market. But in reality, it's what's up here. A lot of these mistakes will make you profitable even if you're trading trend lines or whatever other nonsense you learned out there like candlesticks. It really doesn't matter as long as you have your mind locked in, so really pay attention to the psychological mistakes that you're making over and over again. Journal about them, realize them, and try to fix them as soon as possible, because those things are the things that are holding you back. Thank you all for sitting through this video, and I hope you learned something valuable that you're going to take into your trading next week. Thank you again for watching this video, and drop a comment down below of what you think is the most important thing that you're personally going to focus on. Without further ado, I'll catch you in the next video.